So continuing with chapter 11, we saw this when we started chapter 11 that as we were finishing up chapter 11, we saw that each of the securities that we had started analyzing, the treasury bills, corporate bonds, global portfolio, large cap stock, small cap stocks, and so on and so forth, each one of them had a return, a risk and a return profile. So that risk and return I can plot over here as I have done. So each of these dots or these squares represent the risk return characteristic. So on the x-axis I'm plotting risk, and on the y-axis I'm plotting return. Okay, so I'm going to erase all of that. You can see these, and they are kind of nicely ordered. They're nicely ordered, and if you were to put a line through all of that, that trend line would look like this. So intuitively we know that treasury bills are less risky than, let's say, small cap stocks. They're less risky and they also have less reward, as one would intuitively expect. Small cap stocks are more risky, higher reward, as one would expect. So the distribution of the different investment choices that we have along the risk-return space matches up with our intuition. So the general relationship between risk and reward is this upward sloping line. Treasury bills are virtually risk-free and yet have a small return associated with them, about 3% return, average, historic averages. And higher the risk, higher the return, as one would expect, because if more risky securities did not provide us with a higher return, we would simply not invest in those securities. So that aligns well with our expectations. So that's one thing that we learned from this graph. But there's another interesting thing that is happening in this cluster over here. Look at this cluster. This cluster represents different types of stocks. Small stocks, mid stocks, large stocks. While the portfolio of these stocks line up pretty well, the individual stocks are kind of scattered. They're kind of all over the place. The 1 to 50 are the large, and these are the mid, and these are the smaller within the S&P 500 portfolio. So they're kind of scattered all around. So that tells us that the relationship between one individual stock, the risk-return relationship of one individual stock, may or may not align as well as the risk-return characteristics of the portfolio. Another way of saying it is that the total risk of each stock over here, whether they are the yellow triangles or these blue diamonds or these yellow circles, the individual stocks, the riskiness of those individual stocks are made up of several things. They are made up of some things that are independent to the stocks themselves. Independent to the stocks themselves mean things that are very specific to that company. For example, a company could be hit with a lawsuit. That's very specific. That's an independent risk. A company may have a change in its CEO. A company may announce an earnings surprise that it earned more than it expected. A company may have patents, that they won new patents, or they are opening new markets, announcing new export markets, for example. All of these are examples of independent risk, risks that are very specific to that particular firm. So one firm may be sued for some environmental problem, another firm may hire a star CEO, another firm may announce some special earnings, but they're specific. But not all firms will have a lawsuit at the same time. Not all firms will change CEO at the same time. And then there are a cluster of risks that are common to all stocks. For example, interest rate changes, inflation, unemployment, the unemployment rate, GDP. All of these are common. They're common meaning they are things that affect every stock in the economy. So there are two sources of risk that are present in each stock, or each company is impacted by two sources of risk. A source of risk that is independent of one another, and a source of risk that is common across the board. With this understanding, if I begin to put stocks, individual stocks, whether they are, we had different shapes of stocks, these three stocks, and we put them in one portfolio. When I put these stocks into one portfolio, what happens? Well, when I put these stocks into one portfolio, the independent risk that they each face may begin to cancel each other. So when one company has some bad news, being sued for something, another company may have just earned a patent. So when this company has bad news, this company may have some good news. So the bad news and the good news may begin to cancel each other. So one company loses stock price, their stock price go down, and the other company's stock price goes up. They may cancel each other. That's what I mean by canceling each other. But the risk that comes from these sources, interest rates, inflation, unemployment, GDP, the value of the US dollar, and so on and so forth, those risk factors will impact all of the stocks in the portfolio. In other words, I may have the possibility of diversifying this risk, eliminating that risk. Not that risk is not present, but I can eliminate that by combining stocks into a portfolio. A portfolio will begin to eliminate those risks by canceling each other out. The larger my portfolio, the more chances that these red risks begin to cancel each other. But the purple risks can never be gotten rid of. And the reason being that those risks are common to all stocks. Even if you buy all of the stocks that are trading on the New York Stock Exchange, for example, you will still not be able to immunize the portfolio from risks related to changes in interest rate, inflation, unemployment, or GDP. Those are factors that will still remain within the portfolio. So, from this we can then conclude that there are some benefits of diversification, definitely. Diversification can be beneficial. It is beneficial because it eliminates these sources of risk, this risk source. But diversification benefits have also a limit. They cannot completely eliminate risk. Diversification can reduce risk, but diversification cannot eliminate risk. So in a large diversified portfolio, the common risk is still present, but the independent risk is eliminated. So in a In a large portfolio, the common risk is not eliminated. That means the common risk is present. And in a large portfolio, the independent risk is eliminated. That means it is not present. Okay. So how does this thing play out? The risk that is coming from events related to a company are called unsystematic risk. And the risk that is coming from factors like inflation and others, inflation, interest rate, GDP, they are called systematic risk, also called market risk. So there are two sources of risk that impacts a stock: systematic risk and unsystematic risk, or market risk and unsystematic risk. The unsystematic risk in a large portfolio can be eliminated. So what remains in a large portfolio are the market risk or the systematic risk. And how does that play out? It plays out in this manner. So if I have only one stock in my portfolio, now my portfolio has both systematic and unsystematic risk. I add a second stock to my portfolio. Let's say I add a second stock to my portfolio, and I somewhat eliminate the independent risk, but I cannot completely remove it. But if I keep on adding more and more stocks, add a third stock, fourth stock, fifth stock, sixth stock, a 10th stock, a 100th stock, what is happening? The purple line is beginning to flatten out. That means by adding more and more stocks, somewhere, let's say around 20 stocks, I have eliminated all of the unsystematic risk. But what I have not been able to eliminate are the systematic risk or market risk. I've not been able to eliminate that. Since I cannot eliminate this systematic risk or market risk, even if I add 1,000 stocks into my portfolio, that means this systematic risk or market risk is the most important driver of my portfolio's performance. And so in the next chapter, we will learn about how to measure this systematic risk, and what do we do once we have measured it. How do we use that risk that we have just measured to determine what should be our expected return from investing in this stock? What is the expected return to be expected? What is the return to be expected from investing in a stock with a particular systematic risk? Okay. So because diversifiable risk or the unsystematic risk, diversifiable risk or unsystematic risk, since that risk can be diversified or eliminated by simply adding more and more stocks to our portfolio, there is no reward for this risk. That's what we call the risk premium. The premium, the reward that you will receive for accepting that risk. That premium is going to be zero because this risk can be eliminated through diversification. So investors are not compensated for holding unsystematic risk. So if your portfolio has unsystematic risk, you will not receive any additional reward. The market will not reward you for it. If you diversify properly, then you should be able to eliminate all of the unsystematic risk. So unsystematic risk is diversifiable, and thus there is no risk premium. However, the systematic risk is not diversifiable. I cannot eliminate it, so I have to receive a compensation for it. If I want to buy stocks that have higher diversifiable risk, then I should expect compensation for that risk. So our focus should be on systematic risk. So the risk premium, the compensation that we receive for investing in risky securities, is a result of the systematic risk of that security and not the diversifiable risk of that security. That's very key. It's a key insight. So there is no relationship between volatility, which is sigma, and return. No relationship. But there is relationship between systematic risk and return. And we will learn what the relationship is in next chapter. So that concludes chapter 11.